All property investors should know about the capital gains tax 50% discount, because it could end up saving you thousands of dollars when you eventually decide to sell your investment property. Hi everybody, Shukri Barbara here from Property Tax Specialists. I'm here to help you navigate the complexities of Australia's property tax regulations. Unfortunately, capital gains is an inevitable part of the investment journey. Because your investment property is used to produce assessable income, if you make a capital gain from the sale of your investment, ATO wants to know about it. Essentially, the capital gain is considered part of your annual income and will need to be reported in your income tax return in the year in which the sale is made. Thankfully though, ATO does allow you to claim certain capital gains tax concessions, one of which is the 50% discount. This could save you thousands of dollars on the eventual sale of your investment property. And I'm going to show you how. But before I get into the details, you should know that this information is intended to be a guide only, providing an overview of general information available to property buyers and investors. This guide is not intended to be an exhaustive source of information and should not be seen to constitute legal tax or investment advice. You should, where necessary, seek your own advice for any legal, tax or investment issues raised in your affairs. If you watched any of our previous videos, you would know that ATO allows property investors to be exempt from paying capital gains tax in certain circumstances. For example, the capital gain 6-year absence rule allows you to treat your property as if it was your main residence for a period of up to 6 years and still rent it out. This way, you can sell your property within 6 years and qualify for the main residence exemption. There's also the 6-month rule, which allows you to hold 2 properties as your main residence for up to 6 months, so that you have time to dispose of your old main residence without triggering liability for capital gains tax. But if you don't qualify for the main residence exemption and none of the other concessions apply, you may still be able to reduce your CGT liability significantly. Where the property has been owned for more than 12 months, a 50% capital gains discount may be available. Don't underestimate how much of a difference this can make to your bottom line. Let me show you. Say, for example, you bought your investment property for $625,000. You decide to renovate it and then sell it in 10 months' time for $900,000. The cost base, which includes the purchase price, the stamp duty, the conveyancing fees, and the sales costs, adds up to $660,000. This means that the capital gain on your investment property will be $900,000 less the cost base of $660,000, which equals $240,000. The capital gain may push you to the higher marginal tax rate of 47%, so you'll end up paying an extra $112,800. Where the investment property has been owned for longer than 12 months, you'd qualify for the capital gains discount, 50%, in which case your capital gain will be halved from $240,000 to $120,000. This means you'll also halve the amount of tax you'll have to pay. So, instead of paying $112,000 in tax, you'll only be paying $56,400. See what I mean when I said you could literally save thousands of dollars? Of course, a lot of planning goes into when you sell your property. This was just a simple example, and your situation may be different. For example, your property may be underperforming and you need to sell it as soon as possible. In that case, it would make more sense for you to sell it rather than wait to get the 50% discount. It all depends on your circumstances. But at least now you know that the discount's available to you, should you decide to only sell the property after 12 months of owning it. I hope you found this video helpful. If you're feeling uncertain about anything related to capital gains tax, our qualified experts at Property Tax Specialists can help you maximize the value of your investment property and minimize the amount of capital gains tax you may have to pay. Otherwise, that's it from me. Remember to like and subscribe to our YouTube channel for more property investment tips. See you next time.